So, if you don't start saving until you're age 45, you'll need to save 3 times as much as if you started at 25 in order to accumulate the same amount of money. The moral of the story, of course, is the earlier you start investing, the better. 0.75%, less than 1% in investment fees equates to a 30% smaller nest egg in just 20 years. Moral of the story, keep the fees low on your investing. Before we go on, let me just mention this. Because I don't know any of you in here and where you are as far as knowledge of investing, I have to assume you know nothing. So please don't be insulted if this is too basic, because this is investing 101 after all. So I'm going to assume you don't know anything. Hopefully, even if you know a lot, and many of you do, I'm sure, hopefully you'll still pick up some nuggets along the way. The average retirement account in the United States generates less than $400 per month for income at retirement. $400 a month is the average retirement income from investments in the United States at 65. So why am I excited to teach this class every year? Been doing them for 15 years here. Why? It's because my hope is that I'm going to help you avoid some of the investment mistakes that people have made that I've observed in my financial planning practice for the last 40 years. And also, the more you know about investing, of course, I think the more you're going to be motivated to do some investing. One of the biggest fears people have is, I don't know anything about it, so I'm scared, I'm just going to keep my money in the bank. There's a place for money in the bank, of course, but there's a place for investing. So what we're going to be talking about, I'm focusing in on today, is investing. That's why you're here. Here's my contact information. I'm going to give you this only because there's usually a lot of questions that come up after this class. Please feel free to contact me either by phone or by email. No cost or obligation. You don't have to become a client. This is a ministry to me here at this church. So please feel free if you have any questions on anything we talk about, or for that matter, on anything in the investing area. Feel free to just fire off a little email, leave me a message. I'll get back to you. We have 1 hour here together. That's it. We obviously can't drill down too deep in 1 hour. Okay, so what's the difference, if any, between investing and saving? Let me just start by asking you a question. What is the difference? What do you think the difference is between saving money and investing money? Anybody? Speak up, just so I can't hear you.
Investing is money to grow for the future, where saving is for something a little more immediate.
Good. Good. Okay. Anybody else? Difference between saving and investing. Come on.
I guess investing would be stocks and bonds and such, savings would be a bank account, or
Which one's riskier?
stocks and bonds.
Yeah. So most people need to be doing both, right? But yes, there's definitely a difference. Saving typically allows you to earn a lower return, but with virtually no risk to your principal, which you've already said. Investing allows you to potentially earn a higher return, but you take on the risk of loss of principal when you invest. Okay, so it's saving and investing. We're going to focus obviously on investing today. However, let me add this. I don't think you should be investing 1 penny until you have adequate savings as a reserve against emergencies, for emergencies. I would recommend that you have a minimum of 3 times your monthly expenses sitting in the bank. Lazy money, not earning anything. It's earning less than 1% today. But it's an insurance policy against having something come up that's going to require you perhaps to borrow money to take care of. So you need an adequate reserve for emergencies. We had a class 2 weeks ago on the 10 baby steps to financial freedom. And one of the early steps in those 10 is to create an adequate reserve for emergencies. I told the class a couple of weeks ago that 80% of Americans don't even have $1,000 in the bank. So please don't take risk with your money until you have that stash of at least 3 months of your 3 months worth of expenses sitting in the bank. And why do you think that's so important? Why do we as financial advisors, in every financial planning book you ever want to read, tell you to at least have 3, perhaps 6 months of reserve for emergencies? Why?
Because emergencies always happen.
Pardon?
Emergencies always happen.
Life happens. The reason most Americans are in debt is because they don't have that reserve. In an emergency, something comes up and they have to credit card it to pay for it. Right? We've all been there. I've been there. So that's my little warning before we get into investing. I'm not saying you should tune out for the rest of the time if you don't have that reserve. Certainly absorb what I'm going to tell you, but please, that reserve is so critical. Can't help but just tell you that a couple of weeks ago when we did this class, we talked about establishing a reserve for emergencies. Several people were saying, well, I don't have any money to set aside to create this reserve. I can hardly pay my bills. So I gave them a couple little tips on how they can relatively easily accumulate actually $3,000 in a 1-year time frame for a reserve. 3,000. How many of you heard of the nickel challenge? Nickel challenge. No one? If you were in that class, you heard of it. But the nickel challenge is you get a piggy bank, you put a nickel in on the first day. The next day, you put in a dime. Next day, you put in 15 cents. And each day, you added an additional nickel, 20 cents, 25 cents, 30 cents, and so on. For a year, you'll have $3,000 plus. The most you would have to save in any one day throughout that whole year with this nickel challenge is how much, do you think? The most you'd have to save in any one day throughout the year, putting a nickel, adding an additional nickel each day. Any guesses? $18 and something. It's the most you'd have to save in any one day. So I challenge any of you who don't have a reserve, reserve for emergencies, take the nickel challenge. Okay. Compound interest. Compound interest is, in my opinion, the main reason why people should start investing early. Because it's the miracle of compound interest is really, really, over time, going to really build up that nest egg. And just to dramatize just how important compound interest is, let me illustrate by asking you a question. If you took 1 penny and doubled it every day for just 30 days, how much money do you think you'd have? Just a guess. 1 penny doubled every day for 30 days. That's compound interest. How much do you think you'd have in 30 days? Wild guesses. 2,000? Pardon? $1 million? Anybody else? Kelly? How much if you take a penny a day, okay, penny a day, double it every day for 30 days?
30 days?
30 days. Just double the penny every day. So it's 1 penny, 2 pennies the next day, 4 pennies the next day, right? 8 pennies. How much are you going to have in 30 days?
750,000.
Okay. Any other guesses? We had $1 million over here. We had 2,000 here. How about $5,368,709? There it is on the screen. The miracle of compound interest. But remember, that's 100% interest, right? You're doubling it. So it's a rather dramatic example, but the power of compound interest, very, very powerful. Okay? We're going to talk about 3 different, what I call asset classes of investments available. There are many more, but I'm going to cover these 3 because this is Investing 101, very basic. We're going to talk about stocks, bonds, and annuities. Okay? So let's first take a look at what a stock is. Most of you know what a stock is, but here it is on the screen if you don't. It's also known as equity, stocks, equity, synonymous terms, right? It's a security that represents ownership of a fraction of a corporation. So if you own a share of IBM, you're part owner, fractional owner of IBM. The entities, this entitles the owner of the stock to, as it says, a proportion of the corporation's assets and profits equal to how much stock or shares of that stock you own. Units of stock are called shares. Most of you know this, but perhaps some of you didn't. The key takeaway for stocks is you're an owner. As you'll see in a minute, if you purchase bonds, you're a loaner. Owner, loaner, owner, loaner. Stocks, you're part owner of the company or companies that you're investing in. You have the right to vote at their annual meetings. You're an owner of the company. Fractional owner. Most people, you can buy individual stocks. You can buy stocks through mutual funds. Most people are much better off purchasing stocks through mutual funds, or ETFs as they call it, exchange-traded funds. They're very similar. It's really a basket of stocks. Mutual fund can contain hundreds of different companies, so you'll have a share part ownership in hundreds of different companies if you're in a stock mutual fund. The beauty of mutual funds is the performance of the funds that are available to all of us is public knowledge. You can you can Google IBM stock or any company you want, and it'll pull up all the appropriate data on how that company and how those stocks have done over time. Okay, so that's stocks, keeping this very basic. Bonds. A bond is a loan from an investor, you, to a borrower, such as a company or a government. So you can purchase bonds from a corporation. Why would a corporation want to issue bonds, do you think? Why do they issue bonds in the first place?
To grow the company?
Yeah, they want money. So what they're going to do is ask you to loan them some money. That's called a bond. You loan them $10,000, they issue you a $10,000 bond, and they're going to pay you interest on that bond for the use of your money. Okay, so that's a bond. You're not an owner, you're a loaner. So you're not part owner in the company. You're a debtor. Now, you can purchase bonds, again, through individual bonds, or you can do mutual funds. What would you say the average annual return on stocks has been since 1926? Average annual return on a good basket of stocks like the Standard & Poor's 500, which is 500 of the top companies in the nation. What would you say the average annual return on stocks has been since 1926 till today? Average. What do you think? Guesses?
20%.
Pardon?
20%.
20?
10.
10?
6.4.
6.4. I like that. 10.5% has been the average annual return. Now that means there's some years, as you all know, when the market can go up 20 or 30 or 40%, and there's others when it can go down just as much, right? But the average has been 10.5. What do you think the average annual return on bonds have been for the same period of time?
3%.
3?
20.
How much? 2? 5. So the average annual return on a good basket of bonds has averaged 5%. So we got 10.5 for stocks, because you're taking more risk, right? With stocks than you are with bonds. You're an owner, not a loaner. Bonds still paid pretty good, 5%. How about cash? Money market accounts, savings accounts, those kinds of things in the bank. What's the average annual return on that since 1926? 3 is right. Yeah. Yeah. By the way, real estate's been 6. So stocks by far, over time, have been the best performer of all the asset classes. Okay? An annuity. Just read this along with me. An annuity is a long-term investment that is issued by an insurance company and is designed to help protect you from the risk of outliving your money, outliving your income. Through annuitization, you purchase payments. your purchase payments, in other words, what you contribute, can be converted into a guaranteed stream of monthly income you can never outlive. So think of an annuity as a private pension. Social Security is an annuity. If you have a government pension or a pension from any company, that's an annuity. An annuity, by definition, is a stream of income you can never outlive. So if you're not fortunate enough to have a pension where you work, and many Americans, fewer and fewer Americans today have a pension, it's usually a 401k, something along that line. And then what many people do is they utilize a portion of their assets to purchase an annuity, which would supplement Social Security later on as a guaranteed stream of income. The goal, which we'll be talking about next week if you attend, next week's going to be on retirement planning, 10 major mistakes people make in retirement planning. The most important thing in retirement planning, maybe a better way of saying it, my happiest clients who have retired are those that have sufficient guaranteed streams of income to pay their basic bills every year. They wake up January 1st every year and they know that they've got a guaranteed paychecks, Social Security, private pension, corporate pension, enough guaranteed money is coming in to keep the ship afloat without worrying about what that crazy stock market and bond market are doing out here. So ultimately, the goal should be for all of you is to, over time, build up sufficient guaranteed streams of income to pay your bills. Wouldn't it be nice knowing that even though you're not working and don't have a paycheck, that you've got enough paychecks coming in to pay your bills for the rest of your life? Guaranteed. That's the goal. It starts with investing, though. You have to accumulate money in order to purchase things like annuities that guarantee these streams of income. There are basically three types of annuities. By the way, I want to emphasize the previous slide. This is a long-term investment. This is designed, annuities are designed to be a retirement vehicle. In fact, the IRS is giving you an incentive to invest in annuities because the earnings grow tax deferred in an annuity. Regular mutual funds, stock mutual funds, bonds, you pay taxes every year on any gains. Annuities, you don't. Annuities are the tax treatment of annuities is the same as your IRAs or your 401ks, where the earnings are growing tax deferred. However, because it is a retirement account, and because the government has given you this nice tax incentive to invest in them, they're going to slap your hand if you take money out prior to age 59 and a half. There'll be a 10%, what they call premature withdrawal penalty, if you take money out of this annuity prior to your, quote, retirement type age, 59 and a half. That's the magic age. Why they came up with 59 and a half, I don't know. But that's the number. So please don't put any money in annuities unless you can leave it alone for the longer term. I want to stress that. A fixed deferred annuity means you start putting money, maybe it's $100 a month, maybe it's a lump sum and you put $25,000 into this fixed deferred annuity. It's pretty much acts a little bit like a CD. The insurance company is going to pay you X amount of interest that's declared. You'll know whether it's fixed deferred annuities today are paying in the neighborhood of around 3.5–4%. This is a safe investment. The principal is guaranteed, cannot go down with the market. Acts pretty much like a little CD where the principal is guaranteed. You get a declared amount of interest for a certain number of years. Typically, it could be 5 years, 10 years, and so on. There are no fees involved. Just like with a CD in the bank, you don't pay a fee to open a CD at the bank, do you? No. How does the bank earn money if you don't pay them a fee when you invest $10,000 in a CD? How does the bank earn money? Pardon? Loans?
They use that money to invest while they have it.
Yeah. So they take your $10,000 and they say, we're going to pay you 2% for the next 5 years. They'll take that $10,000 and invest it in stocks or bonds, whatever, usually bonds, hoping to get more than that 2%. And they will over time. They'll get 4 or 5. So they're paying you 2, they're getting 4 or 5. It's the difference between the 2 they're paying you and the 4 or 5 they're getting. It's called the spread. That keeps the lights on in the bank, pays the tellers, the officers of the company. So it's out of the spread, but you don't pay a direct fee. You don't write them a check each for a fee. Same thing with annuities. With the exception of variable annuity, there are fees, heavy fees in the variable annuity. We don't have time to go into any depth about any of these annuities. If you have questions on any of them, if you're interested at all in exploring it, let me know. We could even do a little WebEx meeting together remotely, and I could explain as much as you want about it without any cost or obligation. But time does not permit me to go into any detail. I will touch a little bit on the buffer annuity because that's the hottest annuity being sold in today's market. As the name implies, a buffer annuity gives you a buffer or some protection on the downside when the market goes down. So with a buffer annuity, you're actually the insurance company is giving you the opportunity to allocate a portion of your money into several different stock indexes, like the S&P index, the S&P 500 index, or the Russell 2000 index, which is small cap stocks. So you'd be allocating a certain amount. Let's say you're putting in $25,000, you could allocate $10,000 to the S&P 500 and $15,000, say, to the Russell 2000. Each year, the insurance company would take a look at how those indexes performed, and if it performs, let's say, at 10%, you would be paid 10% interest on the amount of money you had that you'd allocated to that particular index. If, on the other hand, the indexes did terrible for the year, like this year, the S&P 500 index is down in 2022 roughly 18 to 20% already this year. If you're in the buffer annuity, the first 10% of any loss the insurance company would absorb. So if the S&P was down 8% in a year, you lose nothing. That's the buffer. It's a buffer against loss. If it was down 12%, then you had a 10% protection level, and then you'd be down just 2%. Buffer annuities, no fees, just like the fixed deferred, no fees, minimum of $25,000. Long-term investment, of course, to age 59 and a half. But it's really, really popular. Why? Because you can capture pretty much of the upside all the way up to 13.5%. If the S&P goes up that much, you're actually credited with 13.5. Pretty good. If it goes up by 20, how much do you get? 13.5. It's capped at 13.5. But if it goes down in a given year, as I mentioned, goes down 5, 8, 9%, you lose nothing. You could even have a 20% protection level if you wanted to do it that way, but then the upside is somewhat less. enough said on buffer annuities. Any interest in that, just let me know. We can talk about it. Let's move on. I don't want to run out of time. I want to leave enough time for some questions, too. How many of you have access to a 401k at work or a 403b or something? Looks like about maybe a quarter of you. By far, the best way to accumulate wealth in this country is to invest in a tax-deferred, tax-deductible type of retirement account, whether that's a IRA or a 401k. We'll talk about Roth in a minute, but the 401k and the traditional IRA are by far the best way to accumulate wealth. Why? Because you get a double tax break that you can't get anywhere else. Uncle Sam really wants you to put money into these accounts. Why? Because they don't want you to go on welfare. That's why. They want you to be self-sustaining when you retire. So they give you a huge carrot to invest in, the tax carrot to invest in these kinds of plans. So for every dollar you put into a traditional IRA or a 401k, for every dollar, Uncle Sam is going to basically match about 30 cents on that dollar, depending on your tax bracket. So you put $1 into an IRA, traditional IRA, Uncle Sam gives you 30 cents of that back in your pocket, but you still keep the dollar in the account. If you don't put the dollar in there, Uncle Sam keeps the 30 cents. So that's their incentive to get you and me to put money aside for ourselves when we retire. Same thing's true with the 401k. What's the second tax? So the first tax break is tax deductible. That's that 30 cents you're getting back for every dollar you put in. What's the second? Any guesses? What's the second tax break? Pardon?
When you take the money out?
No, you're taking money out, you pay tax.
Oh, I see. No problem.
But while the money's in, you got a double tax break. The tax deduction, but what's the second one?
You don't have to pay tax.
Right, the earnings grow tax deferred, just like with annuities. So you put money into these accounts. Let's say you've left it in there for 10 or 15, 20 years, let it grow. You haven't paid any tax on any of that profit over the years. Now, you will pay the piper when you start taking money out. But in the meantime, 100% of that is growing. It's undiluted by paying taxes. So 100% of it is growing. That's the way to accumulate wealth in this country. Tax deduction on upfront, tax deferral on the back end, get into some good stock and bond mutual funds, and be consistent, putting money away each and every year. That's the way to accumulate money. And I think you know that instinctively without my telling you that. But it's so critical. I have so many clients coming to me when they're 60 years old and they don't have a pot. Most of the time, it's not their fault. Life just happened. Life came along. They didn't have a chance to do it. But many times, they haven't been taught or motivated and shown how they can actually take a relatively small amount over time with compound interest and have it grow into something sizable. A Roth IRA. Roth IRA first came in this country around 15, 20 years ago. And Roth IRA, unlike the excuse me, the 401k and the traditional IRA, the Roth IRA, you put money in after tax. You're putting money in before tax with the 401k and traditional IRA. That's why you're getting the tax deduction I mentioned. With the Roth IRA, you put money into the Roth IRA after tax, meaning you don't get a tax deduction up front. You don't get that 30 cents back when you put the dollar in. So why would I want to do that, Mike, if I don't get that 30 cents back? Anybody know? What's the advantage of the Roth IRA? The earnings grow tax-free, not tax-deferred. Tax-free, meaning over time, as that account grows and you get to retirement age, you can actually take out all those earnings and pay zero tax. Highly recommend a Roth IRA to a lot of people in the right circumstance, especially if your tax bracket is relatively low, where a tax deduction doesn't really mean much at this point. A Roth IRA would be the way to go. Many companies offer a Roth 401k. And so what I'll recommend to those people that have access to both a traditional 401k and a Roth is split the baby. Put 50% of their contribution into the Roth 401k and 50% into the traditional. That way you've got tax diversification. Again, not enough time to drill down too deep in any of these, hoping maybe to plant a seed here and there in your minds. If you want to explore any of this at any point in the future, you can do it by reading books, going online, just Googling Roth IRAs. You can Google any of these things and just get a wealth of information and educate yourself. Don't have to come to people like me. Fortunately for me, most people don't want to take the time to do that, or I wouldn't have a business. All right, let's talk about asset allocation. We've talked about stocks, bonds, and annuities. We've talked about the difference between savings and investing. So now let's say you have some money to invest. You have your reserve for emergencies. You've been faithful to set up that stash in the bank. So now you're saying, Mike, I'm ready. I'm ready to invest. So let's say you come to me, or you want to do it on your own, that's fine too. Whatever you want to do. And you have, let's say, I'm going to pull a number out of, let's say you have $5,000 you want to invest. So you're going to say, what am I going to invest it in? I mean, I have all kinds of choices. I have individual stocks, I have stock mutual funds, I have individual bonds, I have bond mutual fund choices. I could put it in cash, but that's not investing, that's saving. There's something called the rule of 100 that has been around forever in the investing world. It's not a rigid rule, but it's a pretty good, handy rule when you're thinking about asset allocation. And what does asset allocation mean? It's simply allocating a certain portion of that 5,000 we're talking about, allocating a certain portion in stocks and bonds, cash. You're allocating it, you're diversifying by placing money in different categories. So you come, the rule of 100 is very simple. Subtract your age from 100. If you're 50 years old, from 100, that's 50. That means 50% of your 5,000 should go into stocks and 50% should go in bonds. If you're 20, 20 from 100 is 80. That means 80% of your 5,000 or $4,000 should go in stocks and the balance in bonds. If you're 60, 60 from 100 is 40, 40% in stocks and 60% in bonds. Hopefully you're seeing a pattern here. The younger you are, the higher the percent should go in stocks. The older you are, the lower percent should go in stocks. For obvious reasons, right? If you're 60 years old, you don't have as much time to recover from the inevitable downturns in the market as you do if you're 20. So the rule of 100 is a pretty handy-dandy little rule to help people that I use, and basically with many of my clients, to help them sort of get a feel as to what proportion of their investable assets should be in equities or stocks and what proportion should be in the somewhat safer stuff, the bonds. Rule of 100. One of the best ways to invest is dollar cost averaging. How many of you putting money into your 401k every paycheck? Several of you, okay? You're dollar cost averaging already. So what does that mean? Dollar cost averaging means you take a certain amount of money each during a time frame, whether it's a month or a week, a certain amount of money, and you're investing it into, you're investing that money into, say, a stock mutual fund, and you don't, it doesn't matter whether the mutual fund you're investing in is up or down. Each month you're putting the money in, you're going to put the same $100 in there each and every month. Even if the mutual fund is down in value, same 100 goes in. If it's up in value, same 100 goes in. If you do that faithfully, over time, the average cost of buying those shares is always going to be less than the average, the average price you pay for it is always going to be less than the average cost of those shares. So, and why is that? If you're putting $100 into a good mutual fund, sometimes when you do it, you're buying more shares. Other times when you put the 100 in, you're buying less, right? I mean, if the value of your mutual fund, the value of it is down, and you're putting the same 100 down into it, you're buying proportionally more shares than if the value of that mutual fund was up. And so dollar cost averaging is perfect for most Americans. You're not taking the full $100,000 and plunking it into the market, and then if the market crashes the next day, you're, oh, woe is me, I'm down to 80,000. No, you're gradually, over time, putting money into that good investment, gradually doing it, and over time, it pays off big time. Again, you can Google dollar cost averaging, go into a lot of detail about it. Most people who accumulate large sums of money use dollar cost averaging through a 401k or their IRA or some other annuities. Many different ways of doing it, but dollar cost averaging. What's the disadvantage of it? Well, the disadvantage is if you happen to, let's say you have that $5,000. Instead of putting $5,000 all at once into this investment, you decide you're going to put $1,000 into this investment over 5 months. You're going to spread it out. So instead of putting the full 5, you're going to put $1,000 in a month for 5 months. That's called dollar cost averaging. The disadvantage of that would be, what if the market during that 5 months went straight up? Well, you've only put $1,000 in instead of the full 5,000. On the other hand, if it went straight down, you'd be very happy you just put the 1,000 in. But dollar cost averaging for most of us is a smart way to set money aside over the long term. Rebalancing. Again, this is basic investing. You talk to any wealthy person who's accumulated wealth over their lifetime, they will tell you that they faithfully rebalance their portfolio. What does that mean? Well, let's say in our example, you've invested $5,000. Let's say you've got 50% in stocks, mutual funds, and 50% in bond mutual funds. And let's say 3 months from now, you take a look at your portfolio and the stocks have gone up. Now you've got 53% in stocks and the bonds have gone down, because usually if one goes up, the other goes down and vice versa. So now you've got 5,300 in stocks and only 4,700 in bonds. Oh, my bonds are down. My stock's up, yippee. Most of us, left to our own devices, wouldn't think about taking the 300 profit that you have in your stocks and buying these lowly bonds that are down in value. Right? Human nature is, I want to take more of these bonds and put it in stocks. That's what's going up. And that's where people get in trouble. We try to time the market. Rebalancing forces us to do what we would not normally do, and that is take profit off the table periodically. Stocks are up. Let's take some of that profit and let's put it into these bonds that haven't done so well, because you're buying a bunch of shares, you're buying more bonds, you've reduced your stocks, and over time, by so doing, by rebalancing your portfolio like this, you're back to the risk tolerance level you wanted to start with. Because remember, the rule of 100 said you should have, if you're 50 years old, 50% in stocks, 50% in bonds. What if the stock market does so well, now all of a sudden you got 70% in stocks and only 30% in bonds? Now you're outside of the risk profile that you wanted to be in. You wanted to be in 50-50. That was the rule of 100. So what rebalancing is doing is getting you back to that 50-50. Or 80-20, or wherever you started. Most 401k companies will allow you to automatically go online and set up a rebalancing program. Well, they'll do it automatically for you every quarter or every year. Just check your website. If it doesn't, you need to do it manually by doing your own calculations and picking up the phone, calling your HR people. Hey, shift some money from here to here. Remember, there's no cost for making those changes. So dollar cost averaging, rebalancing, important. Teach you two little rules of investing. Already told you about the rule of 100. How many of you have heard of the rule of 72 or the rule of 115? Anybody? Good. I can actually teach you something tonight. That's great. All right, the rule of 72. You divide the return you're getting on your investments, whatever that is. Let's say it's 6%. Your average return on your mutual funds, let's say it's 6%. If you divide 6% into 72, what's the result? 6 into 72 is 12. So if you're able to get a 6% average return on your money, you'll double your money every 12 years. So let's take an example. Let's say you have $1,000 to invest, and you're able to get an average return of 6%, okay, every year. If you do that, in 12 years, you'll have $2,000. You will have doubled your money. That's the rule of 72. If you were able to get let's say a 10% average return, because remember, that's been the average return of stocks since 1926. If you're able to get a 10% average return, how many years does it take to double your money? How many? Yeah, 7.2 years. 10 into 72. So in 7.2 years, you'd have double whatever you started with. The rule of 115 works similarly, except you divide the return that you're getting on your investments into 115. The result is the number of years to triple your money. You can dazzle your friends at the next little party with all this brilliant math you've just learned. Just handy little ways to help you see the value of investing. You can see if you're only getting 2%, 2 into 72 is going to take a long time to double that money, right? We're almost to the end. I'm going to leave time for some questions. A couple quotes from Warren Buffett. I made my first investment at age 11. I wasted my life until then, he said. Someone sitting in the shade today planted a tree a long time ago. Compound interest over time. We simply attempt to be fearful, he says, when others are greedy, and greedy when others are fearful. Right now, I could bet everything I have that Warren Buffett when everyone is fearful about the market, what's happening in the market right now. We're in a bear market. We just entered a bear market for the first time in 10 years. Bear market is when the S&P 500 is down by 20% or more from its most recent high. We just crossed that barrier about a month ago, 3 weeks ago. So people are fearful. That's when Warren Buffett is buying stuff. He's buying. When everyone's greedy and the market's going up like crazy, everyone's putting more money into the market, he stays back in cash, waiting for it to go the other way. Why does he want to buy when it's way down low? He's buying good stuff at a discount. It's like going to Shoppers Warehouse or something where you can get a huge discount on anything. And same thing with stocks. When stocks are down, assuming they're good stocks that you're investing in, good companies, good mutual funds. Obviously, the best time to buy it is when it's on sale, right? And right now, there are hundreds and hundreds and hundreds of companies on big sales. But it's scary to do it. But, oh man, what if it keeps going down? Let me just say this. 99% of my job with my clients is holding their hand. It's behavioral finance. Because most of us, including myself, over time, we do the wrong things. We panic. We put the plan together to try to accomplish a certain goal and objective in the future, and then as soon as things don't go the way we want them to go, we stop following the plan. Okay. So, okay, Mike, all that sounds good. How do I get started with this investing? Well, I would suggest, if you haven't already, that you educate yourself a little bit before you come to a financial advisor and pay them a fee. Many, many good books on investing. At least learn what the basic language is all about. Mutual funds, dollar cost averaging, rebalancing, asset allocation. Familiarize yourself with the language a little bit so that when you're sitting down with him or her, you have a frame of reference. A couple of investing for beginners, investing for dummies, in any bookstore you go into. You can certainly get it on Amazon. You can always consult an advisor. Most advisors will offer you a free, no obligation initial consultation to see if you're a good match with him or her. And the last point there is, I have a lot of people who come to me and say, yeah, but my brother said I should do this. He got rich doing that. My sister, you should see what she did. She invested in this very unusual program. I think that's what I should do. Just get a second opinion is my advice before following a non-professional as advice, as well-meaning as that sister or brother might be. Okay, so that's essentially what I wanted to cover. How about some questions? It's 8 o'clock. What time do we have until, I think we have another 10 minutes, don't we? Yes, sir.
What's your opinion on cryptocurrency?
My opinion on cryptocurrency. It's very risky. It was 60,000 as little as less than a year ago. It's now down to 20. Bitcoin's down to 20. A lot of people your age are asking me that question because it was doing so well and people getting rich overnight on it. And so they're just, I can tell you this, it's not regulated. It's like the Wild West. There's no regulations at all, like there are with regulated stock markets. I would recommend, and I have some clients who I've said, yeah, I think you should invest a portion of your money in crypto if you want to, but treat it as a gamble. So they'll call me and they'll say, Mike, you've put together the financial plan for me. I really have an itch to invest in this thing called cryptocurrency. Can I do it and still reach my goals that we've set? And I said, let me get back to you, and I'll call them back, and I say, yep, you can afford to invest $50,000. Based on your total, you can afford, but just remember, you could lose the whole thing. But if you do, you're still going to be able to reach your objective. I've had others where I've had to say, no, 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 no. I don't think it would be very wise for you to put 1 penny in crypto, because you can't afford to lose it, even that 1 penny. You need it all to reach your objective. My opinion of it, my broker-dealer, for example, that I have to work through legally, will not allow me to sell crypto to anyone until it's regulated. They don't want to, it's just too risky. So I'm not trying to talk anyone into it or out of it. It's just, for me, I'm not ready to do it for myself or anyone else. Any other question? Yes, ma'am.
I've had family members that made a lot of money in 2 different things. One is foreign currency during times where they, understood that country is going to be
Yep,
doing well.
yep.
And, well, what do you think on that personal?
I don't know enough about foreign currency. That's not my thing at all. So I don't know. My approach is very conservative. I've been doing this so long. I've seen so much happen in the markets over time. I've seen so many fads, let's call them, come and go in investing. So, because I've seen people really get burned over not in what you're talking about necessarily, but in other things, I stick to the basics. Regulated, diversified mutual funds, ETFs that are fully diversified, fully managed, public knowledge, that you can look at the records. That does not mean, as I mentioned earlier to this gentleman, that I wouldn't say, yeah, go ahead and take a flyer. You can afford to take a flyer with X amount of money. I've had some people say, what about a penny stock? I've been reading up on this penny stock. I know it's risky, but I just have a hunch it's really going to do well. Can I afford to put any money into that penny stock, Mike? And I'll look at their situation and I'll say, yeah. And I run all the numbers and say, what if they lost this $50,000 they want to invest in this penny stock? Are they still going to be able to reach their goals? If the answer is yes, I say, yeah, go ahead, take your flyer.
The other is gold and silver, things like that.
Yeah, gold and silver has not been a good investment since 1926. It's averaged 2.5%. Gold and silver does well, of course, when inflation's going up, right? And it's a good hedge when inflation's going up. But over time, no, it's not paying any dividends. It's not paying any capital gains. So I don't usually recommend it. But, I mean, right now for inflation, I bonds are really hot. Inflation bonds, I bonds, paying 8.5% or something like that right now. So if you want to ever look into that, a lot of people are doing that. Just Google I bonds. Okay. Any other questions? Yes, ma'am.
What would you say would be like the least amount that we should have to start investing?
It depends on the type of vehicle you're investing in. If it's a regular mutual fund, you're saying the minimal amount to get started? Is that your question? Yeah. Depends on the mutual fund company. Vanguard is the largest mutual fund company in the nation. Fidelity is second. American Funds is third. I know the American funds, the least amount is $250. The minimum, you can start with $250. Vanguard, I think it's $1,000. I'm not sure what it is with Fidelity, but it's not a whole lot of money. It's not like you have to have $10,000 to get started. Good question. Yes, sir.
You had an opening statement, the broker fee.
Pardon?
In your opening statement, you mentioned like a broker fee of 0.75.
Yeah.
And you
Well, right. That's what the mutual fund charge. The average fee, 0.75, is if that's what the mutual fund company is charging to invest your money and grow your account. If it's 0.75, the brokerage fee could be on top. If you're working with a broker, it could be an additional 1% on top of that because you're paying him or her a fee to help you.
You were talking about how it affects your
Yeah.
and what was that percent? Like points?
Over 20 years, it reduces your the amount you accumulate by 30% over a 20-year time frame. So what I recommend to all of my clients, and certainly to all of you who are going to be investing, make sure you look at the ongoing annual cost of the fees of the mutual fund that you decide to invest in. Vanguard, Fidelity, the American funds all are known for their low fees. But even those fees are sometimes going to be 0.50, 0.60. Some of them are 0.5 or 0.10 and lower. But you don't want to be over 1% for sure. ETFs, all of those companies offer ETFs, and they're even lower in cost than mutual funds. Exchange traded funds, they call them. Pretty much like it's a basket of stocks, just like mutual funds.
How do they differ, the ETFs?
With mutual funds, the best way to say this, with mutual funds, throughout the day, you can't really buy and sell throughout the day. You have to wait till the end of the close of the market. With ETFs, it's like buying individual stocks. You can buy and sell all throughout the day, take tax losses throughout the day that you couldn't do with mutual funds. Again, go online and just put in ETFs. It'll give you the pros and cons of them over mutual funds. Okay? I would recommend ETFs in most cases over the mutual funds. Mm-hmm. Yes, ma'am.
Is there an age that you recommend starting to take stuff out of a 401k, or is it just based on your tax bracket?
Well, and your need for cash, right? I mean, if you need money when you retire, it doesn't matter whether you're 70 or 65, you're going to start to take the money, right? But if the longer you, obviously, this is obvious, the longer you wait, the better to start taking money out, because that way it can continue to grow. But yeah,
There's no magic age like that, 59 and a half.
59 and a half is the earliest you can take money out penalty-free from an IRA, from a 401k. Remember, there's a 10% premature withdrawal prior to 59 and a half that the IRS slaps your hands with. But after that, it's penalty-free. That 10% goes away. Yeah. All great questions. So I've confused you? It's a lot. I know it's a lot. But you need to get started someplace, and this is a great way to start. I'm proud of you for coming in, frankly. There's a lot of people watching online. I'm proud of them for watching. Yes, sir.
So like say for example, I was to like take everything from this class and just like go home and start looking at all the money that I have, and then start building my wealth and get to wherever I'm trying to go back into the stock market too, or whatever. How do I create like the savings plan that I look at how much I can be able to save into ETFs, stocks, mutual funds, bonds, or...
You use the rule of 100, first of all, to determine, as a guide, how much of whatever you're going to invest should be at risk, in higher risk in equities, and how much should be in somewhat lower risk in bonds, right? So that's the first thing to do. So how old are you?
I'm 24.
You're a youngster. So 24. So you should have 80% roughly of whatever you're investing in stock, ETFs, or mutual funds. Stock mutual funds or stock ETFs, 80%. 20% should be in bonds. Okay? And so where do you go to buy? I would suggest you start with contact Vanguard You can just Google Vanguard. It's the largest mutual fund company in the nation. Okay? They have all kinds of ETFs and mutual funds. If you'd like more specific information about which of the many hundreds of different funds with Vanguard or Fidelity, email me, call me, and I can give you some suggestions. Be happy to do it. Okay? Remember, there's two ways to invest. You have to make up your mind whether you invest on your own or whether you want to retain the services of an advisor. Okay? Everyone has to choose. Do you want to build your own deck or do you want to hire someone to build a deck? It's the way to look at it. And remember, if you hire someone to build a deck, you're going to pay them a what? You're going to pay them some sort of fee. Same thing with an investment advisor. You pay us some sort of fee. So, but if you have the time and the interest to study and figure out what you want to do on your own, and then certainly build a deck by yourself and save the fee you would pay to the advisor. Typical fee for an advisor is 1% per year on average. And what does the advisor do? Well, they do exactly what you're talking about. They'll actually put together a financial plan for you for that 1%, and then they'll talk to you at some length about your risk tolerance, how much risk you want to take, how old are you, and so on, and then make recommendations where to invest it and help you actually do it. But you pay that fee. Yes, ma'am. 1% of the principal? Pardon? Yeah. Yeah, 1%. And as it grows, we earn money when you earn money. So the more you earn, the more an advisor would earn. The less it grows, the less we earn. So we're sort of partners in that area. Yes, ma'am.
There's never been a time in most of our lifetimes where inflation has been this high and groceries and gas and stuff is double and stuff like that. With your experience, what is your, not prediction, but what I mean? What do you foresee happening?
I see this inflation and high interest rates sticking around for quite a while. A possible recession coming down the road, maybe in 2023 is what I see. Doesn't mean it will happen. Certainly not guaranteed. But we're in for a rough patch. But remember, for the last 5 years, stocks are up 70%. 70% if you've been in the market. Way up. So we have this, okay, we're going to have this dry patch for a while. But that's investing. Don't invest your money in the stock market if your stomach, if you develop an ulcer every time. I mean, on average, since 1926, the stock market has had a 10% what they call correction on average every 2 years. Bear markets happen on average every 8 to 10 years. We're in one right now. On average, it takes about a year and a half to get out of a bear market. Then we're back on a roll again. The market trend has always been up, no matter what, world wars, recessions, depressions. The stock market always recovers and it always goes up. As long as there's good companies in this capitalistic society we live in, it's going to continue to go up. But you have to be willing to put up with temporary pain from time to time. If you're not willing to do that, don't get in it. You shouldn't be in it. I have some clients who definitely I would never put into stocks, ever, because I know they couldn't stand it. Okay? We're almost out of time, but.
Would you recommend CD?
CDs? CDs aren't paying much, but that would be saving. Remember we talked about saving and investing, that's not investing. But for your reserve for emergencies we're talking about, sure, a CD would be great. Sure. Yeah, because that's going to pay a little more than a money market account or your savings account at the bank. Right, a little bit more. Well, thank you very much. It's 8:15. I think we're out of time, but thank you very, very much for coming. I appreciate it. Good questions.
Thank you.
You're welcome.